Hello, welcome to our Expat College Savings and 529 Plans webinar. I am Jake Mongler and my associate is Kathleen Kaffer. We are going to start the webinar here in about 2 or 3 minutes or so. We'll give people just a couple more minutes to trickle in and then we'll get going. So thank you for joining us today. We're going to give everybody about 1 more minute and then we'll get started. I still see people coming in and then we'll start the webinar. Thank you.
Okay, so let's begin. Welcome to our 529 Plan and College Savings webinar for expats. We are Thun Financial, the international wealth management team at Creative Planning. I'm Kathleen Kaffer. I'm an international wealth manager.
And I'm Jake Mongler. I'm also an international wealth manager with Thun.
Today, our webinar will be recorded and you will receive a replay link after the webinar, so please expect that as well.
And as we proceed, as you have questions, you can please put them in the question box. We do have a Q&A section at the end, so we won't be answering questions as we do the presentation. Presentations take about 30 minutes, probably a little bit less than that, and then we'll move into the Q&A.
Here's our disclosures. We'll leave this up for a minute so you can read them. Okay, a little bit about our presentation today. First, we'll do an introduction to TUN and creative planning, and then we'll do an overview of college savings and 529 savings plans in particular, discuss the unique circumstances that American expats face when it comes to college savings, discuss college savings as a part of financial planning, and then finally, as Jake referenced, we will do a Q&A session, and we will get to all of your questions, so please submit them in the chat box. I'm sorry, in the question box, not the chat box.
Okay, so who are we? Hopefully you have some idea who we are since you signed up for this, but just to kind of give you some overview, we are Thun Financial. We are the international advisory group within creative planning. We were acquired last year by creative planning explicitly for our international expertise, for the kind of things you're going to see us talk about in this webinar today. We are an investment management and financial planning firm. We take a comprehensive approach to building long-term wealth, customized for expatriates. That was what what TUN was founded upon, and that's really what we've been doing for over the last decade, is serving Americans abroad, or people not necessarily even Americans abroad, who have some sort of cross-border tie, usually with the U.S. Our client base is very global. We have clients in over 60 countries, and we are registered with the Securities and Exchange Commission. We are a fiduciary to our clients. So a fiduciary means that legally we have to act in our client's best interest. We can't prioritize ourselves or the firm over whatever our client needs. So it's what Kathleen and I would be doing anyway, but we do have a legal requirement to put our clients first.
A little bit about creative planning. Creative planning has frequently and consistently been ranked as a top investment advisor by the Financial Times and also by Barron's. As of December 31st of last year, we had $69 billion in assets under management. We have 32 offices in 20 states, and as Jake just referenced, we're fiduciary to our clients. We also have access to several custodians, TD Ameritrade, Schwab, Pershing, and Fidelity. The latter three are great at working with American expats, and we'll discuss that a little bit later. Here is some of the methodology for the rankings that creative planning has received, so we'll just leave this up for a moment.
So here's the TUN team. You can see the dozen people here who are on the international advisory team. You can see here a variety of qualifications: CFP, CFA, JD, MBA, etc. And the majority of the team has actually been expats. We've lived the experience that you're going through right now. Quite a few of the team members are married to foreign citizens. So we really we have, on a personal level, we understand what our clients are going through, and we can use that expertise. We also have just a very long history of working in this industry. We understand, what it takes to provide comprehensive financial planning and investment advice. So TUN has been recognized very widely for our expertise in this area. You can see some of the publications we've been represented in, and probably a lot of people just find us whenever they search for just generic terms on Google or wherever. They'll come up with TUN articles. We are very big believers in sharing our knowledge with other people, and that's really what this webinar is about. It's part of our service to clients, and then people who aren't even necessarily our clients, but to just try and increase knowledge, because ultimately expats get a fairly raw deal. And we're going to talk more about that, just some of the complexity that you get caught in. So we really try to serve everybody within the expat industry. So moving on into the actual webinar, we're going to start out here, and this is probably not a shock to anybody, but one of the big concerns with college savings or savings for education is just how expensive it's gotten. The chart there shows for the US over the last 30 years. In yellow, the cost of college tuition and fees has grown much faster than the cost of inflation. CPI, Consumer Price Index, is headline inflation. So no surprise there that college education has been growing at a much faster rate for the cost for it. But it's not just the US. I have a couple of pull quotes here for Canada and Australia showing that they're growing very quickly too. That's true for pretty much all the places in the world that'll charge you for education. And even in places where you can get potentially a free college education like Germany, there's always the risk that because costs are increasing so quickly, ultimately the state may make a decision at some point to no longer pay for all of that. And so that puts a lot of pressure on parents to ensure that they can actually provide for their children, or maybe not parents, but grandparents, whoever it is who's trying to cover for the cost of college. So, and there's a variety of questions that come into that. You know, will my child go to a U.S. or foreign university? How will I pay for it? Is there U.S.-based college savings plans that I can do? And then what are the drawbacks for that? What are the tax implications of all that? And these are all the questions that, you know, there's a variety of questions. We're going to work on covering those today. One thing I'll point out here too, as we go through this presentation, there's a variety of pictures. Those are for foreign, so non-U.S. universities that do accept 529 funds, so that they're 529 qualified. This is Trinity College in Dublin, so you'll see that as we go through. So we'll talk more later, but there are quite a few foreign universities that do accept 529, are qualified to accept 529 funds. So before we start talking about 529s, though, I'm going to issue a disclaimer. So 529s are the most popular college savings plan in the U.S., and for a very good reason. They come with a variety of great tax benefits for U.S. taxpayers. They actually have all these special little carve-outs within the tax code that other plans or other programs don't get. That said, for expats, they are frequently not the best option for many expats. So I'll say that again, they're frequently not the best option for many expats. And we're going to talk about why that is and then give you some other options later in the presentation. But I wanted to go ahead and issue this disclaimer now because we're going to start talking about 529s. And if you only join us for the first 20 minutes and then leave, I don't want you thinking, oh, great, this solves all my problem, I'll just go do this. There are a lot of drawbacks that we'll talk about. The best use case for a 529 is for somebody who's temporarily overseas, but planning to return to the US with beneficiaries who will also be attending US schools. So once you start changing some of those things, if you're living long-term overseas, if your child you're not sure is going to go to a school within the US, maybe they're going to go to a local university, and if you are also staying in a jurisdiction, especially a jurisdiction that may tax a 529, then suddenly 529s look like they may not be as good as you would hope. So with that, I'm going to hand it over to Kathleen to talk about the benefits of 529s.
Okay, so the benefits, of course, the earnings within the 529 grow tax-free and can be withdrawn tax-free when used for qualified educational expenses. This is, of course, the benefit that everyone is seeking from a 529 plan, the value of the compound growth over the years, tax-free, that can accumulate, assets and funds for your children for college at a much faster rate, if not taxed. Distributions are tax-free, U.S. tax-free, when used for qualified tuition expenses at trade schools, community colleges, and universities. It's important to note that the qualified expenses are fairly narrowly defined. That would include tuition and mandatory fees, room and board, textbooks, supplies, and computers. Notably would not include expenses such as travel or transportation, which may be relevant for expat families. There's other ways to use 529 funds without paying a penalty. $10,000 from a 529 plan or plans can be used to pay for student loans of a 529 beneficiary and their siblings. That is a lifetime per person limit though. Additionally, up to $10,000 a year can be withdrawn for primary and secondary school tuition, but only tuition, so not other fees. And this may also work for international schools, but you would want to check with your U.S. tax preparer and custodian before relying on that if you're considering using those funds for an international school. Additionally, there's a flexible contribution schedule. $15,000 a year per individual can be contributed to a 529 plan under the gift tax exclusion, or $30,000 for a couple. You also have the possibility of making accelerated contributions of $75,000 for an individual or $150,000 for a couple. So that would be the equivalent of, rather than making 5 years of $15,000 contributions a year, you can make $75,000 contribution or $150,000 upfront. Additionally, the beneficiary of a 529 plan can be changed to another family member, including yourself, without penalty. So this makes 529 plans a great estate planning tool. The general nature of 529 plans is that they're run by U.S. state governments, but there's no residency requirement. You do not need to be a resident of a particular state to use that state's 529 plan. Please note that because these plans are run by state governments, the rules can vary. And so today, while we're discussing 529 plans generally, you would want to look at the specific rules of your 529 plan before making any changes or any decisions when it comes to the plan. Americans abroad who are not subject to state taxation can choose freely amongst the state plans. You want to pay close attention to the fund options and fees. And additionally, contributions are not tax deductible at the federal level. So if you're a net US taxpayer, making a 529 contribution will not reduce your US tax bill. One common question we receive is, what if you don't know where your children will go to college? That's very understandable if you're an expat family. The good news is that a 529 plan does not affect where or which school a child attends. So a family and a parent can live in London, invest in a Utah 529 plan, and send their child to school in Boston. 529 funds can be used at any accredited university in the US, but additionally, and very key, is that as of the last year, there were 400 international schools that were eligible for use of 529 funds, or over 400. However, if you do not use the funds to attend an accredited institution or other qualified expenses, a 10% penalty and US income tax will be assessed on the earnings if you make a non-qualified withdrawal.
So thank you, Kathleen. So I'm gonna jump back in and talk about some of the drawbacks. So and Kathleen kind of hinted at one of them there at the end. But the key thing there, and it's highlighted in red bold letters there at the top, and this is true for pretty much everything that Thun works with clients on, is it's essential to consider the cross-border tax implications whenever you're doing college savings or pretty much most things. So as an American abroad, you have the unfortunate situation of having to worry about citizenship-based taxation. The US is one of the few countries in the world that taxes its citizens no matter where they live in the world. Most countries do residency, where if you're living in the country, that's where you're taxable. So what ends up happening is you're taxable not only on the US because you're a US citizen, but then in your local country. And so now you have to worry about two tax systems. And the problem is there's no mention of educational savings plan in any of the US tax treaties. So these are treaties that the US has entered into with another country that's supposed to minimize or eliminate double taxation. And it lays out all these different terms, but there's no mention of an educational savings plan. You're not going to find, like, say, oh, 529 plans, they get special treatment in the UK or in Germany or in Japan. So investment gains and distributions may be subject to local country tax laws and receive no preferential treatment. So generally what I tell people is, you know, you should expect that if you have a 529, a Coverdell, some sort of educational savings plan, it's probably going to be looked at as a brokerage account in that local country, with the expectation that you would report the dividends and the gains. And the problem then is you now have a 529, which also has its own restrictions that Kathleen talked about, that you have to use it for these qualified things, but yet the local country is going to look at it like a brokerage. So it's like a brokerage account with all these extra rules and penalties. So, and it even becomes more of a problem because 529s are not really designed to give you the information on dividends, on interest coming off the account. So you'd really have to dig in there, and maybe there's something in the plan documents where they'd be able to tell you that. Maybe you have to like dig down into the fund and then pull out, like, here's the distributions, here's what I estimate it is. So it gets very complicated very quickly. I'll be honest with you, the reality is there's a lot of people who have 529s abroad and they don't report them, mostly because they're not aware they're supposed to report them. But that is problematic, that if you were ever audited by the local country and they found out about the 529, more than likely that could cause problems. So that bullet point there at the end, here's one simple option that if you have a 529 overseas on how you can simplify things, is change the owner. So in a 529, there's the owner, that's usually the adult, the parent, maybe the grandparent on the account. And then there's a beneficiary, and that's who the minor is, generally the child, grandchild, although you could be both the owner and the beneficiary. But if you change the owner, so change the adult from the person who's living overseas to a trusted family member still in the US, then that way you could set it up to where now you eliminate a lot of these tax implications. So let's say you're living in France and your parents, the grandparents of your children, are still living in New York or California. If you change the owner from you to your parents, now it's not reportable on your taxes. It's in theory reportable on their taxes, but in the US, there's no reporting for 529s. So it simplifies that, and then you kind of you get away from a lot of those tax implications. There's a couple drawbacks here. One, you need to, of course, trust the person. You don't want to put your black sheep brother on the plan as the owner and then find out, oh, he drained the funds, because the owner has the ability to withdraw the money. So you need to make sure you trust the person, that it's going to be used as you intend. The other thing is it does have some Fafsa implications. We'll talk a little bit more about Fafsa later. That's the student aid program. So if you put like a grandparent on there, that can have a little bit more adverse restrictions or impact on student aid than if it's the parent who has it. So one other thing to be aware of too, so we're primarily focused on US college savings plans in here, but a lot of countries have their own version of like a 529, but those are generally a bad idea for US taxpayers. So US citizens, US permanent residents / green card holders. So like in the UK, there's a junior ISA program. In Canada, there's the RESP. The problem is it's the same problem that you run into with a 529. There's no recognition of those foreign educational savings plan under the tax treaty. And so the IRS, when they go to tax you, they're going to look at it and they're going to see it as a foreign account. And foreign accounts, anytime they're invested in foreign funds, they're going to likely be considered a PFIC. And we won't really get into PFICs here. We do a whole webinar on PFICs, but they're called passive foreign investment companies. They're basically any non-US based fund, and they get very harsh tax treatment. The reporting requirements are very onerous. So generally, we just tell people avoid those. There are ways around it. If you really, if you have a junior ISA or an RESP, reach out to us. We can talk about options there. But yeah, generally, you're going to run into the same problems that you would have if you were trying to take a 529 to, the UK or Germany. So what are the other options out there? So we talked about how a 529 is not always the best option. So I'm going to lay them out here and kind of my order of worst to best. So starting out, US-based retirement accounts. So if you have an IRA, Roth IRA, you can withdraw the money from those accounts for qualified tuition costs without paying a 10% penalty. Generally, if you withdraw from an IRA or Roth IRA before age 60, there's a 10% penalty. There is an exception in there specifically for IRAs and Roth IRAs for educational savings. Does not work for like 401ks and other plans like that, but IRAs it works for. That said, for like a traditional, pre-tax IRA, the withdrawals are still considered to be income, and you're going to be taxed on that income. So if you take, let's say, $10,000 out to pay for your daughter's college education, that's an additional $10,000 of income that you're going to be taxed on in the US and likely in the local country. So that's also, so one, you have to pay tax on it, but then two, now you have to report that additional income on financial aid, and that could reduce your ability to get need-based financial aid. So if you're going to take the money out, it must be spent on qualified tuition costs for yourself, your spouse, your children, grandchildren, or stepkids. The final bullet point is really the kicker here. So this is a retirement account. Retirement accounts are really intended to be for your retirement. What you don't want to do is sacrifice your retirement for your children. I know that sounds kind of harsh. Everybody, I'm a parent of 3 boys myself. I always want to prioritize my children, but also realize that if your child is going off to college, they have a lifetime of earning potential in front of them. If you're on the precipice of retirement, you are just about to enter a period where you're no longer going to have income, and you're probably going to live off that for decades. So really be very cautious and hesitant to do anything that's going to decrease your ability to have success in retirement just to pay for educational funding. So another option there, Coverdell educational savings accounts. These are sort of like the older, less popular cousin of a 529. They existed before 529s. They have a lot of additional restrictions. The big one there is you only put $2,000 in a year. And they have the similar drawbacks to 529s. We really don't see Coverdells used very frequently anymore for good reason. There are some very unique niche cases. And honestly, with like some of the revisions that have been done, allowing you to use 529s for like K through 12 education, it's made Coverdells even less appealing. But they are an option out there. You'll see them mentioned it's very rare where a Coverdell would make sense versus like a 529. So there's financial aid, merit-based, talent-based, need-based. There's scholarships, there's grants, there's loans. So one key thing here, and I think a lot of people don't understand this, is U.S. expats are eligible for financial aid. So just because you're living in the Netherlands, you're living in Thailand, that doesn't mean that your child can't apply for financial aid. You know, they're going back to the U.S., they're going to the University of Texas or something. You can fill out the Fafsa, the free application for student aid, and that would make you eligible for many federal and state-based aid programs. There may be some where, you know, if it's a state-based thing and they're not a state resident, okay, then they're not likely to qualify. But there's nothing to prevent you from applying for it, especially the federal programs. You can qualify for, you know, live in Germany or Sweden or somewhere and apply for that. Just be aware, like 529 ownership is factored in the need-based calculations. Income's also factored in if there's bank accounts. It's a very complicated equation, what gets factored in at what, and it's also in fact includes things like, you know, can the grandparents contribute? Do they have a 529 where the child is the beneficiary but the grandparent owns it? And some of that's being changed right now. I know they're trying to simplify some of the FAFSA rules, so we'll have to see where all that shakes out. But still, I think that the overall takeaway should be that financial aid can be an option out there. So, and then I'm going to finish up here with frequently what's the best option for expats for college savings plan is a simple taxable brokerage account. It's straightforward with the most flexibility. So there's no penalties for changes in timing or use. So you don't have to worry about, oh, you know, I saved, you know, $20,000 in a 529, and now I find out my daughter, she got into the school she wants to go to in Germany, and we don't have any use for it now. What am I going to do with this money? And so then, you know, then you're looking at having to pay the income tax plus the 10% penalty on withdrawals. You don't have to worry about it with the brokerage account. You can change it. You can move it back and forth. It creates a lot of flexibility. It's easy to understand and optimize for local country tax consequences. You know, there's, like I said, expats always get kind of a raw deal in how we have to worry about with taxation. It's usually easiest to optimize things with brokerage accounts because they're straightforward. They're not trying to take advantage of one country's tax code that the other country's tax code isn't even going to acknowledge. One thing to be aware of too is they can actually be pretty tax efficient when you do them correctly. So I know a lot of people say, oh, it's taxable, I don't really want to do that. But if you use the right strategies, and these are the strategies that we use in our firm, is if you use ultra low cost exchange traded funds, tax management strategies like gifting, tax loss harvesting, etc. They're going to vary depending on where you're at, you know, what's your situation, you know, which ones make the most sense. But you can actually make them relatively you can make these brokerage accounts relatively tax efficient, where you're not having to buy and sell. You're not having to recognize a lot of capital gains. Yes, when the child gets ready for college, then you'll have to start doing it. But, you know, there may be some opportunities along the road where, you know, maybe there's a dip in the market, you can sell some things, recognize a loss, reset your basis somewhere else. So yeah, there's some opportunities there to do different things.
Okay, a little bit about how we integrate 529 plans into your larger financial plan. Of course, any education savings plan is only as good as the financial plan behind it and the investment manager who's managing that plan. We integrate college savings plans into your broader portfolio that can include retirement accounts, taxable brokerage accounts, and pension plans. And we also give thought to tax advantages and then also time frame and other goals that you may have. Of course, the 529 plans and college savings are only one part of an integrated investment management and financial planning process when it comes to building wealth over the long run. A little bit about how Thun Financial and Creative Planning work. For most of our international clients, we custody their assets at Charles Schwab and Fidelity and potentially at Pershing as well. These organizations are great at working with Americans abroad. And then we have an ongoing process of creating and managing an individual wealth management plan that includes gathering information about yourself, your family, your situation, establishing goals for you and assessing your financial situation, preparing a very thorough, customized financial plan for you, and then implementing and monitoring the plan over the long term. We also, as necessary, will work with other advisors, including accountants and lawyers, especially estate planning lawyers. And then, of course, integrity, trust, and confidentiality are very important to this process and ideals that we emphasize. Here you can see our fee schedule. We charge a % of assets under management, and that includes all of our financial planning and investment services in the fee. And then here are disclosures again. We'll just leave that up for a moment.
So, and here's the team again. We'll leave this up. Pretty soon we're going to move into the Q&A. So go ahead and add your questions. I see several of them coming in. So Kathleen and I will move into that very soon. And before we move into Q&A, we do want to tease, we do have another webinar coming up. So we just had, we do about one a month. And the one in May is going to be Peter Singelman and David Kinsey presenting on investing and financial planning for Americans in the UK. So we have, the UK is actually our largest non-US country where we have clients at. We do a very UK specific webinar, kind of similar to the general webinar that we did back in February, but UK specific. We talk about some of the HMRC tax rules and different things with the US UK tax treaty to be aware of. If you're interested in that, you'll probably get an email, but you can also always just go to our website, tunefinancial.com. You'll see a register link there on the main page. You can sign up, and we'd like to see you. And so with that, we will move into the Q&A section.
Okay. So Danny asks, regarding the 10% penalty for non-qualified withdrawals we discussed, is that 10% of the earnings or 10% of the tax liability? That's a great question. It would be, the penalty is on the earnings, not the original contributions. And it's important to note that on withdrawals from the plan, it's proportionate between earnings and contributions. So you don't get to decide what amount withdrawn is earnings versus contribution. It's proportionate to what's in the account.
Okay, so Bradley asked, does the IRS publish current lists of qualified international educational institutions? Where does one verify that an international school meets the criteria for 529? So yeah, there's a Fafsa list out there. You can search for it, Fafsa approved schools. We actually have an article on our website where we talk about 529s, but you could just search for it. When you do the search, there's like the official one, I think Department of Education, if I remember, that's who actually the organization behind it. But whenever you go into it, they'll ask for state. If you scroll through the list, they'll have like foreign country. They break out foreign country, and then I think Canada and Mexico are broke out separately. But you could look through that and see where it is. You could put in the name of the institution, and it'll tell you whether or not it meets the criteria for a 529.
Danny asks, changing the account owner trigger gift taxes or any tax consequences for the new owner? That's a great question. Even though the account owner maintains control over the account and the investments, it's considered for US gift and tax purposes as a completed gift. So there's no tax consequences for the new owner of transferring the account.
Okay, and Bradley asks another question. If a parent is an owner living in the Netherlands, does a 529 count for the parent's Box 3 wealth tax? So the Netherlands has a very complicated tax system. Box 3 is sort of like a wealth tax. It's thankfully not exactly a wealth tax. So the IRS will give you foreign tax credits for it. Yes, my expectation would be that a 529 would count towards the parent's Box 3 wealth tax if they are the owner. If you remember the strategy earlier where I said you could put like a grandparent on it who's not there, and it's just like the child is the beneficiary and they're living in the Netherlands, then I would think it would be exempt from Box 3. Part of the problem is, and we'll mention this for some of this, just kind of for full disclosure on the Q&A, there's a lot of gray area. You know, like I said, no tax treaty mentions 529s exactly. And so it's always a little bit, whenever you take something that is designed for one tax code and you try to translate it to other, you're ultimately going to have to take a position. Hopefully with the help of a tax preparer, a local tax preparer who's understanding the tax system and can help you with that. So this is kind of our best understanding of how things should be taken, but ultimately we would recommend that you always get local tax specialist advice for a lot of these positions.
Okay, Maya says, I am an American dual citizen living in Italy with my Italian husband and 3 dual citizen children. We have no idea where they will attend university. The eldest will probably study in Italy, at least for her first degree. What savings plan should we use? 529 clearly does not make sense. Well, Maya, of course, as Jake referenced, you can use regular taxable investment accounts to save for your 3 children for college, and there won't be any special tax benefits of doing so. You'll be taxed on income and capital gains as you normally would, but of course that is also an effective way to save for college and to grow the assets while you're saving. Additionally, you do have another option, which is if you have a trusted family member in the U.S., they would be able to own the account and manage the investments for you. However, as referenced, though, that may not be useful if your children are attending an Italian institution or other institution. But of course, you could look at the FAFSA list to see if those schools are qualified.
So Anna asks, can you clarify whether the $10,000 per year permitted drawdown for K through 12 school fees, not college, is also restricted by the pre-selected list of institutions in the US and abroad? So Anna, this is part of where the complexity with the K through 12 comes in. There's no like pre-selected list. There's no approved list that I've ever seen. So this would be something where if you have a 529, you'd want to check with the custodian, understand what their rules are. I've not seen, so like, you're in a very unique group whenever you're an expat overseas with a 529. There's nothing wrong with having them. Most plans are not going to have explicit rules written out for that very unique case. So I would reach out to them and say, oh, my child's going to a private school in Bern, Switzerland, or something like that. What do I need to show, or can I just take the money out? What my experience, so I've moved around various different states, and I've had 529s in 3 different states. I've taken withdrawals out of a few of them. It's usually pretty straightforward. I've not actually done it for K through 12, but I have looked through kind of like the different plans, and they do vary a little bit on kind of how they have it set up. Usually you just need to affirm that it is for a qualified use. And so it may be the kind of thing where you just need to keep good records to say, yes, this was my child was in, the equivalent of 6th grade in the local school here. We had to pay tuition fees of $10,000. I took a distribution for that $10,000. Our understanding is that it should qualify under this. Again, I kind of go back to my earlier comment, make sure that, you talk to your tax preparer, potentially the 529 custodian, make sure that you're not taking a really aggressive position. But if you're just doing that, there's no like approved list that you have to qualify or make sure that the school's on.
Okay. Danny asks if changing the account owner to someone who isn't considered in the FAFSA calculations is an optimal scenario. That's a great question, and I do want to say that how the account is factored in the beneficiary's needs it varies depending on who owns the account. So if the child is both the beneficiary and the account owner, it's computed one way. If the parents are the account owner, another, and then if a grandparent or a third party is the account owner, it's actually it's calculated at a higher percentage of income or funds available to the child. And I think that's because they're aware of the potential for individuals to try to game the system. Another important point we want to raise is that our discussion is based on tax laws that are current tax laws. And so these can always change and may change over the long term. So that's something to be aware of when trying to devise an optimal tax strategy, is that there's a lot of minutia involved, and it can always change.
Yep. So Peter asks, my wife and I both live in the UK. I'm a dual UK-US citizen, and she is a US only citizen here on a spousal visa. Currently, the 529 is owned by me. Is there any advantage to transferring 529 ownership to her, given that she lives here in the UK as well? Or does this only benefit us if we move ownership to a family member who is a US citizen and resident in the USA still? So Peter, I think, the problem you're going to run into is your wife is, because she's living in the UK, she's UK taxable. So, and the UK is going to tax you on worldwide income. So moving it over to her doesn't really accomplish anything. She would still, in theory, need to report it to the HMRC. They still want to tax her on the dividends and everything. So yeah, you really need to move it back to somebody in the U.S., somebody who's not taxable by a foreign government. So it could be, I mean, you could live in somewhere like, Saudi Arabia or somewhere that's not going to have, have no tax on that sort of account, and that would work too. Usually it's easiest. You've moved overseas, you probably still have family in the U.S. That's the reason we mentioned that.
Okay. Anna asks, can you please clarify the following? Should a child not use the 529 funds to attend an approved institution? Penalty is 10% tax only under U.S. law to withdraw the funds. Can you talk a little bit more about how these can be used as an estate planning tool and how a 529 plan can be passed on to other individuals like a younger sibling? If there are still funds left after the college fees have been paid, what happens then? This is a great question, and of course that is part of the strategy of considering what to contribute to a 529 plan, whether your children will attend university or a qualified university, how much will that cost? So you can of course change the beneficiary to family members, and that tends to be pretty broad. That can include parents, siblings, usually aunts and uncles, nieces, nephews. So there is some flexibility there. But if you do use the funds for non-qualified withdrawals, and bearing in mind that there's other ways you can use the funds to pay off student loans to a certain amount to pay for private school, you will be assessed a 10% penalty on the earnings and pay 10% federal tax, federal income tax.
Yeah. So and that's a good point. So one thing that you can think about is 529s are kind of strange. Whoever makes the withdrawal, they're the ones who are responsible for paying the tax and the penalty. It can actually be beneficial if it is a child who has decided to, they're not going to college, or they're going to a college that's not on the approved list. If they need the money and they take a withdrawal, it probably makes more sense for them to take the money out and pay tax on it than the parent who is probably in the prime of their working years, probably at a much higher tax bracket. It kind of depends. You can get into some very complex things depending on, where you're at, what's all that. But that is something to think about is, if you are going to make a non-qualified withdrawal, who's doing it? What is the tax rate? Or do you just do, as Kathleen mentioned earlier, do you just assign somebody else to be the beneficiary? Maybe you roll it on down. So Bradley asks, does child as beneficiary of 529, do they not have to file a FBAR disclosure requirements once the asset is greater than $10,000? Great question. My understanding is even if the child is the beneficiary, they are not necessarily have to be the one who would have to file. Well, they would have to file an FBAR because I don't think it's a foreign, not a foreign asset. So that's probably the simple answer. We were talking about a 529. If it's a foreign account that they're the owner of, then yeah, they could potentially have some sort of reporting requirement.
Lisa asks, so my brother, my children's uncle, could create a 529 plan for them. He wants to gift them money, but into an account in their name. And I have been advised not to open U.S. accounts for my children who are Italian-American dual citizens. Good question, Lisa. So absolutely, anyone can open a 529 account for a beneficiary. And while the account owner controls the assets and the ability to change the beneficiary, anyone else can also contribute to that account. So you could have other family members or friends contributing to that account, even if your brother is the owner of the account. You do want to talk to your Italian tax advisor because potentially that account could be reportable in Italy for your children, but that would be, I think there's less of a risk there, but something you definitely want to talk to your Italian tax advisor about.
Anna asked, could you clarify how the UK, the HMRC views 529s? That would be great. So kind of similar to what we talked about earlier, HMRC is going to tax your worldwide income. There's nothing explicitly mentioned about 529s in the US-UK tax treaty. It's actually one of the better tax treaties for its comprehensiveness. It recognizes like Roth accounts, not 529s. Maybe they'll do a revision in the future and mention that, but it's not happening. Unfortunately, with tax treaties, just a little digression, they've gotten held up. Rand Paul, the senator from Kentucky, he has like a moral objection to tax treaties because he thinks they give Americans a raw deal, which I would actually argue is quite the opposite. They're actually usually very good for Americans abroad. But he has actually put a hold on almost all tax treaties getting through that Senate subcommittee for the last decade. If he leaves, I could see that would almost be like a dam breaking. There could be a lot more movement in tax treaties. Maybe you would get some recognition for 529s. Part of the issue is most of the tax treaties are a few decades old, and 529s weren't really a thing. You know, you go back 30 years ago when they were writing the tax treaties. So there could be some updates there. So I apologize for that little digression there. So yeah, I would expect that the UK would want to tax you on 529s. One thing to also be aware of with the UK is there's the whole concept of offshore reporting funds. Without getting into too much detail and not stealing David and Peter's thunder for the UK webinar, those are, if they're, the UK will give you preferential tax treatment on US-based funds if they meet certain reporting requirements. And most 529 plans don't do that. We actually have a relationship with like the Utah 529 plan. There are actually some funds within it that meet the reporting requirements. So that's something else just to be aware of, that not only could you have to report them and get taxed on them, you may get an income tax treatment under the HMRC instead of the favorable capital gains treatment. So again, yeah, just Anna, by all means, reach out to us. We can discuss all this in depth, get it set up if you have questions or if you have an existing 529 that you need help on. And then Bradley asks, what's the likelihood Thun will do a Netherlands-specific webinar in 2021? It's not on our list right now. It's what I would like to do. I'm talking to David about what we'll potentially add. I think it's probably unlikely to be in 2021. We have a pretty full schedule for the rest of the year. Thank you, though. Appreciate your interest.
Annie asks, is there any IRS ruling precedent reusing 529 plans to pay for private schools outside of the US? Annie, I don't have the answer to that off the top of my head. You know, we could discuss that. Please feel free to email us, and maybe hopefully we can get an answer for you on that.
Okay, Hart asks, and Hart, I may need some extra clarification here. You mentioned there are quirks for beneficiaries who attend US schools, but not necessarily parents returning. Was this only related to the Fafsa impact? I'm not sure I actually understand that question. I don't know, Kathleen, if you have thoughts on that. So one thing I said was it made sense if your 529s make the most sense if it's a situation where the beneficiary or the parent are going to return. And that's because of the tax reasons. It's also for the beneficiary because there's a lot more schools that are on the 529 approved list within the US than outside the US. You get kind of, your choices get more limited if you're, trying to find an approved school in the UK or something. There's still several out there. As we talked about, there's over 400. But that's kind of that's an impact. There really shouldn't be a Fafsa impact. I mean, you're not going to be able to get Fafsa for a child going to a non-US school. They're for US schools. But if the child, you're living in Germany now and the child's returning to the US to go to school in California, Texas, Florida, wherever, you could apply for Fafsa. So yeah, I don't know if I answered your question, but yeah, please let us know.
I'll add one thing to that. My other thought was part of the complication of 529s is even though for US tax purposes, the account or the funds are a completed gift to the beneficiary, it's possible that other governments or tax authorities would not view it that way. So let's say a scenario where the parents are in the UK and the child returns to the US to go to university, and then the parents try to make the child the account owner. I could see a foreign government considering that a gift to the child that would be then subject to local jurisdiction tax rules. So those types of complexities are the reason that I think, Jake, we say it's ideal if you're an expat for a short amount of time, and then when you're returning to the US, you're not on distributions you're not concerned about whether they're being taxed to or attributed to the account owner or the beneficiary. And if you transfer account ownership, you're not concerned about whether that's a taxable event because it's not in the US. So it's just easier if everyone's a US based person.
Yeah, that's a great point too. So one thing I was working with a client on this who's in Israel, actually his grandchildren are in Israel planning to go to a FAFSA approved school. And we were having a lot of trouble getting clarification on how Israel would treat once the kids start pulling money out of the 529s. One option that we talked about is 529s are really flexible in where the money goes exactly. In a lot of cases, you can just have the custodian, and it depends on the custodian, but you can actually have them send a check or do an electronic payment directly to the university. And so in that case, you maybe even cut the child or the grandchild out of the picture, and you can avoid maybe some of those gift tax complexities if you're having trouble understanding what's going to happen. There's some other complications of why you may not want to do that, but there is some flexibility there in who exactly is receiving the distribution from the account.
Okay. Olga says, we pre-funded our 529 before we knew we'd end up leaving the US. Now we are living abroad and it's unlikely that our kids will study in the US. I'd like to pass the 529 to my nieces who are close to college and live in the US. What's the best way to do so without interfering with their financial aid? Should I make my sister an owner of the account? So as we just referenced, Olga, depending, I'm not sure where you are, you want to consider the implications of how you've been reporting the 529 in your local country and the tax implications of if you change the account ownership. Additionally, there are some complexities based on who owns the account, how withdrawals, even qualified withdrawals, are considered for needs for financial aid. So basically, if it can be if the student or the parent is the account owner, then they may not they may not consider the withdrawal in the current year, in the base year, for financial aid needs. But if a different family member or a third party is the account owner, they may consider the income and financial aid considerations. So you'd want to look closely at that if you're trying to be very strategic.
So Joan asks, we are UK and US citizens living in the UK. Our son is about to go to UK university, which accepts 529s. The account owner is his US grandparent, and he is a beneficiary. Do I understand correctly that we don't have tax implications on either end, or will my son have tax consequences in the UK if he is an adult? Joan, yeah, I don't believe you should. It would be something to ask your tax preparer. I think if he's being issued the money directly, I think you're still going to be fine. There shouldn't be an issue there. And certainly if it's gone to the school, it sounds like you're in good shape.
Hart asks, if a grandparent or relative already owns a 529 on behalf of a parent's child, would there be any benefits to operating a separate one? In terms of funding being available to a child, no, you can contribute just as well to one as to two. I would say that the primary difference would be control over the account and the assets. So a grandparent would be able to control the investments, would take withdrawals if they wanted to, and change the beneficiary. So that might, depending on your situation, that might be a consideration.
Kristen asked, if we were to give the 529 to a trusted US-based family member, what is the Fafsa implication? Again, we're not going to get into a real detailed Fafsa complication or conversation. It's a very detailed calculation. I keep stumbling over that. It basically comes up, it's more adverse. So the way FAFSA work is they depend on what the account is, who's the holder. They come up with a percentage of those assets that would be counted as expected family. I can't remember what the acronym is, but there's an acronym they use to,
EFC, contribution.
There you go, contribution. Thank you. So yeah, it depends on who's the owner, what kind of asset it is, and it depends on, they'll take a percentage of that and say, oh, we expect that 20% of that would be expected to be contributed for the child or the beneficiary's education. If you move it to like a grandparent or something, it's actually treated a little bit more harshly. The percentage goes up than if it's just yours. So yeah.
Joan asks, to expand, does this mean my son will have to file taxes if he uses more than a certain amount? I assume that you mean of the withdrawals from the 529. No, so if withdrawals are made, the plan will issue a 1099-Q, an IRS form, and you only need to report non-qualified withdrawals from the plan on your taxes, and it's not subject. There's not limits about whether it needs to be reported below or above a certain amount. The distinction is whether it's a qualified expense or a non-qualified expense, which would be subject to income tax and penalty on the earnings.
Okay. Rajesh asks, if a U.S. person living abroad has the owner as his father for their grandchild, does the grandchild have to have a U.S. TIN SSN? Can the beneficiary be the U.S. person living abroad and be changed to the child once they decide to apply for a green card? Yes, my understanding is you do need to have a TIN or an SSN to be set up as the beneficiary for a 529. So.
Yes, that's correct. The account owner will need a social security number or an individual tax ID number, and then the beneficiary, you would need their social security number, tax ID number, their birth date, and a U.S. address for the beneficiary. So that can be a complication. Joan says she's hoping we'll do a workshop on taxes for brokerages or PFICs. We want to know how to invest for our son and ourselves without having problems with dual tax. Well, Joan, hopefully you were able to attend the great PFIC webinar our colleague Roger Healy did a few weeks ago. We don't really get into the minutia of reporting PFIC or tax, on tax forms, because that can get very detailed and complicated. But it is our approach to investing and to building, saving for college and building a portfolio that you can invest in a regular taxable brokerage account, and we advise on tax consequences and tax strategy to do so.
Robert, I'll jump in. I'll let you pause for a second. Robert asks, and the lot to unpack here in this question. I have a sufficiently funded Virginia 529 invest account for each child. No contributions made since moving to the UK. Since the funds are non-reporting to the HMRC, that's the UK tax authority, I believe that tax liability in the UK occurs upon redemption of the shares. Assuming my child go to university in the UK, one that qualifies for plan use, and since I have a defined benefit retirement, would it make sense for me to transfer ownership to my wife or children so they can use the £12,500 tax-free exemption each year? So Robert, a couple things here. One, while the fund itself, so you mentioned that you believe that the tax liability only occurs on redemption. That's not, I would say that's probably not true. My expectation would be that if the HMRC knows about it, they're going to expect you to report the dividends every year. Problem is Virginia's probably not reporting that. That's sort of the complexity that I got into. The other issue is that you said the funds are non-reporting, which is pretty typical unless people explicitly know what a HMRC reporting fund is, and it's a pretty small universe out there that do that. They're probably non-reporting. So, and again, not to get too much of the details about UK, because we are going to talk about this. If it's a non-reporting fund, you do not get capital gains treatment. You do not get the £12,000 a year tax-free exemption for that. And the gains are counted as income tax. So if you were in the UK, you're probably in realistically a 40, maybe a 45% tax band. When you go to sell them, and you report it to UK, they're going to want to take a 40 or 45% bite out of the capital gains once you do that reporting. So that's why it's usually so important to get a reporting fund. So you get that, not only do you get the $12,500 tax-free exemption, annual exemption, but you also get capital gains tax treatment, which is only 10% or 20%, depending on what tax band you're in. So Robert, yeah, by all means, reach out to us. We can talk more in depth about kind of your situation, but yeah, so it's a kind of complex.
Okay, I apologize if I mispronounce your name, but Kajite asks, would contributions into a 529 plan reduce my taxable income while overseas, and can be used to push below my tax thresholds? So if you are abroad, if you are a net foreign taxpayer, if that 529 contributions are very likely not recognized. As we discussed, 529 plans are not recognized in any treaty, and so they should not be, we would not expect that they would be tax deductible in your local country. If you're in a lower tax jurisdiction and so you're a net US taxpayer, again, there's no deduction, federal tax deduction for contributions, so it should not lower your federal tax rate. If you are resident within a particular state that offers a deduction for a 529 plan, and you have that state's 529 plan, then you would receive a state tax benefit for contributions, but that would likely be the only case.
Let's see. Carolyn asked another question about Fafsa implications. Carolyn, I think we answered that earlier. Let me know if there's another nuance there that you feel like we did not cover. Tom also asked, you mentioned that a U.S. taxpayer recipient of a transfer of ownership in the U.S. does not have U.S. tax consequences for the transfer. What about the U.S. taxpayer transferor So the person who did the transfer, yeah, there shouldn't be anything there. You can move it back. That's actually one of the weird things about 529s. They have like all these like things that they kind of break the rules. They're a completed gift to the beneficiary under the tax code, but then you can change the beneficiary. There's all these kind of weird nuances, but yeah, basically 529s get all these super exceptions that avoid taxation.
Natasha asks, can a 529 plan be used for graduate school? Yes. So you can, at the Fafsa link that Jake referenced, and that's on it's a link to it on our website with our 529 article. There are many graduate schools for which you can use 529 funds as a to cover qualified expenses.
Daniel asks, I'm sorry, let's see. Yeah, Daniel asked, withdrawal made directly to the educational institution or to me. I'm assuming he's asking about like for a 529. You can actually do either. It depends on how the custodian has it set up. You can have them directly send a check from the 529 to the educational institution, or you can have it distributed to you or to the beneficiary. There's different ways to go about it. So.
Joan says, I'm confused if a child is the beneficiary, who is responsible for UK taxes on 529s? This is a great question, Joan, and as you are aware, it can be complicated. You would want to talk to your UK tax advisor, because it's possible that as a UK resident who is the account owner, the UK could consider them to be taxable on earnings within the 529. However, they could also potentially consider the beneficiary who is the recipient of this gift, so to speak, as taxable. And so I'm sorry I'm not able to give you a better answer. It would be best for you to speak to your UK tax advisor if this is a relevant issue.
Okay, we're actually getting down here to the end. If I transfer ownership to a trusted party in the US, I assume they can later transfer ownership back to me. In that case, if I move back to US, is that right? Yeah, that should be fine, Danny. And that'd be a good case. Yeah, so if you find yourself moving to the UK for a while, you think it's going to be a short-term thing, you'll come back. Yeah, by all means, you can transfer it once you go back and simplify the tax reporting. So I think
we have a few thank yous. I think we can just, if we don't have any other questions coming in, I'll just say, as you know, that 529 plans, the rules can be quite complex, especially if you're concerned about reporting them in other countries. But we're always happy to speak to you about that, and we can very effectively help you save for college, just as we do for hundreds of clients through regular taxable brokerages and other means. So don't be too concerned if you feel that a 529 plan is not a good fit for you and your family. We will help you find a solution.
Yeah, and that's true. Just, I mean, this is like 529s are one very small aspect of what we do. There's a lot of complexity. And again, I'll just say it again, expats always get a raw deal because you're caught in two tax systems that were designed to work together. And that's really what we're here. And I'll personally say that's one thing I love about Thun is the service aspect. Having been an expat, having lived overseas, having dealt with the frustration and the complexity where suddenly it was like I stepped into Wonderland and nothing made sense anymore. That's one thing I love is kind of untangling the complexity and trying to get the best solution possible for people. So yeah, if there's no further questions, then we'll thank you all for your time. There will be, as Kathleen said, there will be a recording that'll be available later on. You're by all means welcome to look at it. We'll also post it on our website for review if you want to come back in a few weeks. So on that note, thank you all very much.
Thank you.